At this time of the year, investors tend to look back on their portfolio picks and try to figure out what to choose or how to increase or decrease their exposure to the next year. To help us work out where these opportunities are, I'm joined by Russ Mould of AJ Bell. So as I was saying, this time of year, Russ, welcome to you, always welcome in the studio. You look back at your portfolio, you look at the mistakes, you look at the winners, the losers, where you went wrong and what you can do next year. So before we do head into what to do next year, let's just figure out what were the winners and the losers then.
Okay, well hopefully there's not too much need to look back in anger on this year, because although it's been quite a choppy year, most things have actually gone up. So if you look, particularly if you've had your money outside the UK, the collapse in the pound means that any overseas assets have had an instant 10 to 20% boost. So that's been one secret part of the secret sauce. But in general, if you look back at the year, lots of volatility to begin as the market's digested the Fed's first rate rise for a decade, then a bit of a recovery, then slight Brexit panic, and then from Brexit onwards, basically, equities did incredibly well, value did very, very well, bonds did less well. Trump, people think that trend started with Trump. It actually started with Brexit, or was even beginning a little bit before then. So it was a big shift. Bonds to equities, quality growth and expensive defensives to value and cyclicals. Those were the two themes. Riding on the coattails of that, emerging markets and commodities did very well as well.
Okay, heading into next year then, what's our plan of attack? What sectors do you fancy?
Okay, well I think for me the big themes, they're all interlinked. They're going to be the dollar, Brexit, Trump, bonds and banks. Right. They're the big things that are going to really drive performance up or down for 2016-17. For choice, I think we think the FTSE 100 is going to be about 7350, 7400 by the year end, mainly because it's dollar exposed. We don't think the pound's going up, we think the pound's going down, and so you still need some of that overseas exposure in there, and that's going to be a big support for the dividend yield for the market in the UK, which is going to be a huge source of support. It's still north of 4%, but it's very dependent on banks and oils. If those sectors do well, the UK is set fair. If those sectors don't do well, the UK might find it a little bit harder work. And on top of that, for the UK, there is some value appearing in some of the downtrodden, unloved, forgotten domestic stocks. And if there is a surprise next year, we think it may be them.
Such as? Can you name a few?
Well, I think general retailers for me look really, really interesting. Though, funny enough, you probably need the dollar to go down for them to do really, really well. Just because if you look at the long-term chart, I'm not a big chartist, but it all kind of helps, there's an inverse correlation between the two. So when the dollar is strong, the retailers do well. When the dollar is weak, the retailers do so well because of the impact it has on their cost base. If I had to pick one retailer, Next to me feels interesting just because at the start of the year people were paying £70 a share for it, or looking at you sort of paying 17, 18 times near peak earnings forecasts. Now back at £50 a share, you're paying 11, 12 times quite a depressed earnings forecast. There's a 3% dividend yield that's 3 times covered, and the company's got a fantastically rigorous cash allocation policy. There may even be buybacks or specials in there if things go really well. So I'm not saying it's going to tear away on you, but I just think it's a well-run company with a sensible balance sheet, a sound dividend yield, that's just been completely ignored and now looks quite attractively valued.
And if you don't fancy volatile stocks next year, what's the insulated ones that you know is just a safe bet? Can you name a few of those?
I think the oils will actually be fine. I know that people, the oil price, having a guess, I've absolutely no idea. If forced to guess, I think it's probably going to jog around a little bit where it is, but with the emphasis on the downside, just because I do worry that the higher oil goes, the more shale production will come back on stream and act as a cap, to be honest with you. But I think, again, with BP and Shell offering 6 to 7% dividend yields, I think, again, if you're prepared to just bank the income and not worry too much about the capital in the short term, they should be okay.
Okay, and where are you as a person steering well clear of? What are you not interested in?
Well, I always find mine is a bit of a challenge, but again, if the market is moving into inflation and growth mode, I think they will do well. I still have my doubts. I still think that debt, demographics, the dollar and the internet are strong deflationary or disinflationary trends. I'd be a little bit worried of going completely overboard on the inflation trade that we've seen this year, and I think if bonds get seriously oversold and treasuries and 10-year gilts go much higher from here yield-wise, I'd almost be looking at them, boring as it sounds.
Okay, and you mentioned obviously being international in terms of defending yourself domestically. Where international is a really sweet spot to
well, I tell you what nobody's talking about. Let's put it that way. Let's start off with that. Japan and Europe. Nobody's going to, if you look at the recent Bank of America Merrill Lynch fund manager survey, the recent survey for the Association of Investment Companies, US, everybody's very bullish. Europe, never got a look in. European stocks are cheap. Relative to the US, always have been, but the gap is quite historically wide right now. Some great yield paying stocks there and some world leaders in their fields. Again, I think a good European income fund maybe currency hedged might not be a bad place to look for 2017 for the patient.
Okay, and just to conclude then, what do you think investors need to do next year? What's your big tip in order to stay ahead of the game?
I think getting. It's incredibly difficult, but you do need to think about currencies because they have been a big driver of performance this year. I think if you think the pound's going down further, and we do run current account and trade and budget deficits that make us look like a banana republic, I think having your money overseas may be one step to giving you a little bit of a buffer for performance in 2017 going forwards.
All right, Russ, that's great advice. Thank you very
Pleasure.
much indeed.
Thank
That's
you.
Russ Mould of AJ Bell. So keeping your money abroad, and we really are watching the currencies in 2017 as we discuss what to invest in.